Celsius recently announced it has locked all of its users' funds within its platform. This means no withdrawals, or swaps, or transfers, with millions of dollars locked up within its protocol. How did this happen, and what is the likelihood that users will ever see their funds back in their wallet? Well, I'm the average crypto investor, and today we will be taking a look at Celsius and the controversy surrounding them. As always, nothing said in this video is financial advice, and you should always do your own research before investing into any project. Celsius is a company founded in early 2017. They are essentially a hedge fund for crypto, claiming to help users unbank themselves through utilizing crypto assets. Celsius may have started with the best intentions, but things have quickly run amok. With Alex Mashinsky at the helm, the early days of Celsius seemed to be wild. Most of the early development was done by contracted Serbian Web3 development studio named MVP Workshop. Now, in of itself, there is nothing wrong with outsourcing some development aspects. However, there was virtually no oversight early on. As Celsius began to grow, Alex brought on such figures as Yaron Shalem to be the CFO and Jessica Cater to be the head of institutional lending. Shalem was later arrested in Israel on fraud and money laundering charges, while Jessica started at the company as an intern and prior to that had no finance or crypto-related experience. With these types of decisions coming at the top levels of management, let's take a look at a few of the missteps that Celsius has had with its funds as well. Did I mention that Celsius is run more like a hedge fund than a bank? Well, that's because they are not only commingling deposits and institutions' assets, they are actively investing them in protocols riskier than the depositors are aware of. The first time investors were made aware was during the Badger DAO hack in December 2021. This was a DeFi protocol that was focused on providing utility for Bitcoin on the Ethereum blockchain. It seems like Celsius had a significant amount of assets on this protocol, and some estimate the losses here to be over $50 million. The next major loss comes off of the collapse of the Terra Luna ecosystem. If you've somehow managed to miss what happened with Luna and Do Kwon, you can check out my video on the fiasco linked up here. During the collapse of UST, Celsius withdrew close to $500 million worth of assets from the Anchor protocol. Many blame Celsius being one of the key players that compounded the pressure leading to Luna's collapse. Now, we don't know how much of a hit Celsius took on these withdrawals or if they made it out whole, but it's hard to think that they were able to move that much money at that point in time without losing some of its funds. Even though UST had relatively large liquidity, the price was already on its way to being depegged. Speaking of liquidity, this is one of the core concepts that has led us to where we are today. Celsius has a liquidity problem, all across the board. Fortunately for them, it played to their benefit early on when they were able to hide their liquidity issues on their balance sheet. You see, Celsius initially raised funds through an ICO of their CEL token. According to Crunchbase, they were able to raise a modest $50 million through their ICO launch. Given that they were selling their tokens for 30 cents, we can extrapolate that they sold roughly 167 million of their 700 million total supply during ICO. Celsius also had another ICO roughly a year and a half later for $15 million. They also had another deal with Tether for $10 million, in which we can assume there was some CEL traded there, so let's round it out and assume that in total they sold roughly half of their supply or 350 million tokens. Now, I'm sure some tokens may have been held and sold later on, or provided to exchanges for liquidity, but Celsius was still going to be a large holder of the total initial supply. So what did they decide to do? Well, there's a fun accounting principle called mark-to-market. What that means is you're able to designate a security that you have on your balance sheet as the dollar value of its current market price. In December of 2020, CEL was trading for roughly $5.50, and Celsius reported to have $1.5 billion in revaluation surplus. Celsius was able to use the mark-to-market designation in order to bring an additional $1.5 billion onto their balance sheet for 2021. And lo and behold, they are able to secure $750 million during their Series B round in 2021 based off of a valuation of $3 billion. The problem with these numbers is the cell tokens that Celsius had weren't actually worth that much. You see, Celsius was controlling the majority of the circulating supply. In order to trade the cell tokens for another asset, there would either need to be a huge price impact or they would need to slowly unwind their balance sheet over months, if not years. You see, price impact can be roughly calculated by calculating your order size relative to the pool that you're trading on. So even if 50% of the cell tokens that Celsius wasn't in control of was sitting in the liquidity pool, if they sell 17.5 million tokens, it will drive down the token price by 10%. Things obviously start to escalate from there as prices get lower and they need to sell even more to compensate. Now there are options for OTC trades or over-the-counter trades. These are trades that don't take place through an exchange but are a private agreement between two parties. Even if Celsius could sell some tokens that way, it would be unlikely that they would be able to sell their entire holdings. So all in all, Celsius is able to raise a significant amount of funds based off of a balance sheet that is hyperinflated. This isn't the end of Celsius's liquidity woes though. Far from it. Over the past few months, we have seen significant drops in crypto prices, stocks, and rising inflation. This has caused many folks to move their assets to safe haven assets like cash and bonds. It also has caused many investors to begin consolidating their crypto assets onto hardware wallets while they wait out the bear cycle. This has caused a twofold impact to Celsius's ecosystem as there are two major pain points in their risky investments. The first is their investments and borrowing in the MakerDAO. The MakerDAO is one of the oldest DAOs and is famous for creating the AlgoPeg stablecoin called DAI. The way that the MakerDAO is able to achieve this is through their vault mechanics. Anyone is able to create a vault utilizing assets like Bitcoin or Ethereum. This is exactly what Celsius was doing with their wrapped BTC. This works great in a bull market since you are now able to get a stablecoin that you can earn yield on. But when we see sharp market drops and bear markets start to come in, that's when liquidations become a fear. Liquidations happen at a present point for which each individual vault based off of the collateralization requirements that were set when the vault was opened. For example, when Bitcoin was worth $50,000, you may open a vault with one wrapped Bitcoin and withdraw $25,000 worth of DAI. Let's say that the vault requires a collateralization of 1.5 or 150% of its borrowed value. So if Bitcoin had dropped to say $30,000, you would either need to add $7,500 worth of Bitcoin to bring it to $37,500, which is the liquidity requirement, or pay back $5,000 worth of DAI so you have 150% of the $20,000 worth of DAI that is collateralized. Now, as we have seen, Bitcoin has been approaching $20,000 in recent days, so Celsius has had to move quickly to avoid liquidations on these vaults. Their funds are in the wrapped Bitcoin Type A vault, which requires 145% collateral. This requires moving assets in and out of other protocols and utilizing various exchanges like Gemini and FTX to fulfill their needs for quick cash. After their recent injections, Celsius has managed to lower the liquidation price to roughly $17,000, but time will tell if they are able to hold this vault or need to start unwinding everything. The next liquidity crisis that Celsius is facing is with their ETH. Right behind Bitcoin, ETH is a powerhouse within the cryptosphere. With the merge coming, although there have been delays along the way, there have been many places where you can stake your ETH to earn future ETH 2.0. The problem is that most of these protocols require to lock up your ETH until after the merge happens. One of the most popular protocols, Lido, gives you ST ETH in exchange for staking ETH to earn a yield, also known as staked ETH. The staked ETH can be used as collateral for loans or can be sold in case you need to get out quickly. Now, staked ETH is supposed to be pegged one-to-one with ETH, but given staked ETH's lower liquidity, they will face the same price impact we talked about with the CEL token. Currently, the curve pool for staked ETH to ETH contains about 490,000 staked ETH, and Celsius has $445,000 worth of staked ETH, so it would be difficult to sell this without some serious losses. All of which leads us to where we are today, with swaps, transfers, and withdrawals disabled for users, and thousands of people wondering if they will ever see their money moving forwards. So where does this leave Celsius? Well, they have a few options. First, they can go and beg every VC, bank, and investment firm in town for money to bail them out. The odds of them getting enough funds to both give investors their money back and avoid liquidations is slim though. The next is to declare bankruptcy. This would be terrible for most investors because this would leave them the same rights as any other creditor during bankruptcy. The likelihood of seeing any money back would be slim to none. The third and final option is something that I recently learned about today, an offer from Nexo to buy out all partially and fully secured loans and customers from Celsius. This, in combination with the first option, could be a way for Celsius to survive this catastrophe and come up with a better risk tolerance policy or unwind their holdings completely. What about the investors? Well, first off, if you have money locked up on Celsius, I'm sorry. I know how stressful it can be when your funds are locked on a third-party platform, and even worse when you don't hear anything from them and everyone is saying it's a scam. There are some folks who are advocating to take them to small claims court depending on the amount that you had with them. This could work depending on where assets are held and how much you have there. Others are advising to lawyer up, again not a bad idea depending on how much you may have potentially lost. But either way, there are some key learnings that we have as well. First off, not your keys, not your coins. This can't be said enough. If the coins are in a wallet that you have control of the keys for, they aren't your coins and they can disappear. They can also be invested poorly and just lost through a hack. Now you can do the same thing trying to invest into DeFi projects yourself, but at least then you have no one to blame but your own investment choices. The second takeaway is anything that seems too good to be true probably is. With Celsius offering insane sign-up and deposit bonuses, as well as offering rates comparable with some of the DeFi scene, it makes you wonder how they are able to offer all of these perks. This is the answer that recently came out. They're able to do this by investing into even riskier projects and taking on leverage to do so. We all want to beat the banks and get away from traditional finance, but each person needs to be fully aware of the risks involved when doing so. Do you still have money invested in Celsius? Do you have a story you want to tell or any more information on what's going on behind the scenes? Let me know in the comments down below. If you made it this far, I would appreciate if you could like this video and help others be aware of what's going on with Celsius. Also, don't forget to subscribe so that way you can be alerted when my next video goes live. That's all for now, stay safe, and don't worry crypto fiends, we are all going to make it.